BNB, OKB, Hype, and Leo. Why Buyback-and-Burn is crypto's stock buyback. Introduction. In traditional finance, the stock buyback has become the dominant way companies return value to shareholders. Instead of dividends, firms use profits to repurchase shares, reducing the float and supporting price appreciation. It is a subtle but powerful mechanism, one that aligns investor interests with corporate growth while sidestepping some of the tax and signaling issues of dividends. In crypto, a parallel mechanism has quietly become the standard: buyback and burn. Exchanges and protocols use revenues to repurchase tokens from the market and permanently remove them from circulation. The result is the same economic effect as a stock buyback: scarcity, price support, and value circulation, but with two critical twists. It is transparent because on-chain burns are verifiable, and it avoids the regulatory pitfalls of promising yields or dividends under the Howey Test. The rise of this mechanism is not just an interesting footnote in tokenomics. It is becoming crypto's version of shareholder yield. And the evidence is written across the charts of tokens like BNB, OKB, Hype, and Leo. The mechanism explained. In equities, the logic of a buyback is straightforward. Profits are deployed to repurchase shares. The outstanding float shrinks. Earnings per share rise, scarcity increases, and prices adjust accordingly. Crypto retools this into buyback and burn. Protocol or exchange revenues are used to buy tokens in the open market. Tokens are then permanently destroyed, or burned, by sending them to a verifiable null address. Supply falls while demand remains steady or increases, creating scarcity pressure. The advantages are profound. No dividends, no promises. Holders simply benefit from engineered scarcity, not a contractual yield. On-chain transparency. Burns are visible and auditable, unlike opaque corporate buybacks. Programmability. Burn programs can be automated, formulaic, or shock-driven, allowing flexibility in narrative design. In short, it is a native mechanism that delivers the same economic outcome as stock buybacks, but fits the crypto environment better. Case studies. Exchange tokens and the burn effect. BNB, Binance Coin, is the original proof of concept. Launched with a quarterly burn program tied to exchange profits, BNB pioneered the model that others now emulate. At first, burns were based directly on Binance's income. Later, the program shifted to an auto-burn formula linked to trading volume and price. Starting point, roughly $20 in its early years. Today, trading near $1,000 at its peak. The compounding effect of steady, transparent burns over multiple cycles has made BNB the poster child for how tokenomics can mirror corporate buybacks. OKB, OKX. If BNB is the slow compounding case, OKB is the shock event. In 2025, OKX announced a single instance burn of 65 million tokens, about 75% of its supply. The market reaction was immediate and violent. OKB surged from around $50 to over $200 in a matter of days. By fixing its supply at 21 million, OKX effectively transformed OKB into a scarcity asset comparable to Bitcoin in structure. The burn acted as both a fundamental change and a marketing bomb, catapulting OKB into the spotlight. Hype, Hyperliquid. A newer entrant, Hype demonstrates how quickly a deflationary model can accelerate value capture. With a built-in burn program tied to exchange activity, Hype surged nearly 960% within a year. Unlike OKB's sudden supply shock, Hype's trajectory shows the compounding narrative of consistent burns. Traders see a built-in scarcity loop and reward it with sustained demand. Leo, Bitfinex, and Tether. Leo introduces an important variation. Because Tether, or USDT, itself cannot burn, it must maintain dollar parity. Bitfinex created an auxiliary token, Leo. Profits from Tether operations are used to buy back a Leo and then burn it. This closes the Ouroboros loop indirectly. USDT operations generate income, which is funneled into scarcity for a secondary token. The model proves that even stablecoin issuers can route value into a burn mechanism, albeit through an additional step. Together, these case studies illustrate the spectrum of burn-driven appreciation. BNB is long-term compounding. OKB is sudden scarcity shock. Hype is rapid early-stage deflationary growth. Leo is auxiliary burn circuit. All different implementations, but one common truth: buyback and burn drives narrative and price in ways no other mechanism has matched. Burn versus no burn, the performance divide. If the case studies demonstrate the upside of buyback and burn, the counterexamples show what happens when it is missing. UNI, Uniswap. As the flagship decentralized exchange token, UNI had every advantage: first mover status, huge user base, and brand recognition. But without a formal burn program, UNI has struggled to capture the same long-term value. Its price action reflects governance hype cycles rather than structural scarcity. The absence of a burn leaves UNI vulnerable to narrative drift. Traders see no guarantee that protocol success translates into token appreciation. Crypto.com. For years, CRO followed a similar path. High-profile marketing pushes, such as naming rights to stadiums and celebrity sponsorships, but no systematic burn mechanism. The result was underperformance relative to peers. Only recently has Crypto.com announced a roadmap to introduce quarterly burns, following in the footsteps of BNB and OKB. The market has begun to take notice, but CRO still represents a late bloomer that may or may not capture the same burn-driven premium. When we step back, the divide is stark. With burn programs like BNB, OKB, Hype, Leo, GT, and BGB, sustained appreciation, compounding scarcity, and strong narrative support. Without burn programs like Uni and CRO until recently, weaker performance, diluted narratives, and constant need for external marketing. This is why we can frame the trend as an exchange token burn index. Tokens with structured burn programs consistently outperform those without them. In traditional finance terms, the burn is equivalent to shareholder yield. In crypto, it is quickly becoming the standard by which all exchange tokens are judged. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Regulatory and strategic implications. Why burns dodge the Howey Test? Dividends, staking yields, or any explicit promise of profit from managerial effort risks crossing into securities territory under the Howey Test. Buyback and burn is different. No payout is promised. No yield is distributed. Holders simply benefit indirectly from scarcity created by the protocol's own actions. This makes burn programs a clever regulatory shield. They circulate value without tripping the wire of expectation of profit from the efforts of others. The marketing effect. For exchanges, the best advertisement is not a billboard or a celebrity endorsement, it is a rising token price. A well-structured burn program becomes a built-in marketing engine. Each quarterly or event-driven burn is a headline. Supply destruction becomes a narrative hook. Token appreciation reinforces user loyalty and attracts new traders. The result is a flywheel. Exchange revenues fund burns, burns drive scarcity, token price rises, higher visibility, more users, more revenue, and larger burns. Burn wars are inevitable. In this environment, competitive pressure forces exchanges to adopt burn programs. If Binance, OKX, and Bitfinex are all tying token value to revenue via buyback and burn, then tokens without such programs look increasingly weak. As with stock buybacks and equities, burn programs are becoming mandatory, not optional. What started as an experiment with BNB has become a strategic necessity across the industry. Future of buyback and burn. Beyond exchanges. The mechanism began with exchange tokens, but its potential extends far wider. Tokenized real-world assets. Imagine tokenized real estate, commodities, or even government debt instruments that generate cash flows. Instead of paying dividends, which could trigger securities regulation, issuers could use income to buy back tokens and burn them. This creates deflationary pressure on the circulating supply while preserving compliance. In an earlier framing, the Ouroboros IP protocol captures exactly this logic. A closed loop where income funds buybacks, tokens are burned, scarcity increases, and higher token value follows. DAOs and DeFi protocols. Decentralized organizations with treasury revenues can adopt burn programs as a governance choice. Rather than issuing yield-bearing staking rewards, which regulators may scrutinize, DAOs could route revenues into buybacks and burns, reinforcing token value while staying one step removed from securities classification. Stablecoins with auxiliary tokens? Leo has already shown the path here. Since USDT itself must remain stable at $1, Tether created an auxiliary token to capture and burn profits. This model could be replicated by other stablecoin issuers, allowing them to monetize seigniorage and operational revenue while maintaining peg integrity. NFTs and creator economies. Even NFTs could incorporate burn mechanics into their economics. A portion of secondary market royalties could be directed toward buying and burning floor tokens or related governance tokens, creating a deflationary floor that rewards long-term holders. In each case, the buyback and burn mechanism is not just a gimmick. It is becoming a crypto-native standard for value circulation, as fundamental as stock buybacks are in equity markets. Conclusion. The evidence is now overwhelming. Across tokens like BNB, OKB, Hype, and Leo, the buyback and burn mechanism has proven itself as the most reliable way to circulate value back to holders. Just as stock buybacks became the dominant shareholder yield strategy in traditional finance, burns are becoming the standard in crypto tokenomics. The logic is simple but powerful. Protocol revenues fund token repurchases. Tokens are permanently destroyed. Scarcity increases, price responds, and holders benefit without ever crossing into the regulatory hazards of explicit dividends or yield promises. Case studies show the range of outcomes: BNB's steady compounding, OKB's supply shock revaluation, Hype's rapid deflationary ascent, Leo's auxiliary circuit built from tether profits. By contrast, tokens without strong burn programs, like Uni or pre-burn CRO, consistently lag behind. The divide is so clear it could be formalized as an exchange token burn index. The implications are both strategic and systemic. Exchanges now compete in burn wars because the market demands it. Regulators struggle to frame it as a security because no yield is explicitly promised. And the model is spreading beyond exchanges into real-world assets, DAOs, stablecoin auxiliaries, and even NFT economies. The takeaway is simple. Buyback and burn is no longer a curiosity. It is crypto's equivalent of the stock buyback. In the next cycle, projects without a burn mechanism will be at a structural disadvantage. Those with it will enjoy a built-in engine of scarcity, narrative, and price support. The burn is not a gimmick. It is the dividend engine of the decentralized economy.